A very good morning to everyone. I'm Arpita Bedekar, and I welcome you all to this webinar by Fintelekt Advisory Services and the Asian Bankers Association on AML Governance. Before we begin, I would like to thank the Asian Bankers Association, especially Ernest, Amador, and Meg, for their unwavering support to us during the year for what I can safely call a very popular webinar series. Today, we have over 500 registrations from more than 35 countries, and I thank you all for joining us. This is our last webinar for 2020, and I would say a fitting topic to close the year, considering that it is finally the right kind of governance that determines whether your organization regards AML CFT as a tick-in-the-box exercise or as a necessary and essential element in maintaining the integrity of the global financial system. We have two experienced speakers today, Tanya McCartney, who is the CEO and Executive Director of the Bahamas Financial Services Board, and Pramod Khandelwal, who is a Senior Faculty Member at Fintelekt Advisory Services and the former Chief Compliance Officer at Intersect Bank in India. The first speaker today, Tanya, is an accomplished barrister, compliance professional, and chartered banker. Since 2016, she has served as the CEO and Executive Director of the Bahamas Financial Services Board. She is the leading advocate for banks and trust companies, insurance, accounting and legal firms, asset managers, along with securities and broker-dealer firms. Tanya is a founding member and past president of the Bahamas Association of Compliance Officers. She is a respected leading voice in the development of a strategic plan for the economic sustainability of the Bahamian financial services sector. She has been recognized as an important contributor who facilitates collaboration between the private sector and policymakers regarding global regulatory initiatives that impact the sector. With that, let me invite Tanya to make her presentation.
Good day. I wish to begin by thanking Fintelekt and Shires in particular, as well as the Asian Bankers Association for this opportunity. There is so much that we have in common and also a lot that we can learn from our shared experiences. Financial services worldwide has had to respond to the onslaught of regulation, which is changing business models, impacting economies, and increasing the need for knowledge, skills, and expertise, especially in the area of anti-money laundering and compliance. I have been involved, so my name is Tanya McCartney, as you will know, and I have been involved with AML CFT for almost 25 years. I served as a senator in the government of the Bahamas when we passed our initial laws in response to an FATF blacklisting way back in 2000. Since then, I have been immersed in regulatory reform and balancing business interests with the need to meet international standards. So I understand that ultimately financial services is about increasing our shareholder wealth and it's business, but we also have to play by particular rules. And it is a pleasure, therefore, to share some of my experiences with this audience. Organizations exist to create value for their stakeholders. The stakeholders are the customers, investors, employees, the government, and yes, the community at large, who can benefit where there is corporate social responsibility. By setting objectives, developing strategies, following through, and continuously improving processes, value is created. In reality, it's not always as simple as making a plan and sticking to it. There's always risk that certain events could affect the success of these plans. We all have heard of Murphy's Laws, so things happen. It's the job of management to make adequate preparations to ensure that systems are in place to continue hitting objectives, even if unforeseen circumstances arise. Enterprise risk management is a direct solution to these kinds of uncertainties. It allows management to oversee the continual creation of value on a complete, integrated, and organization-wide level. By using enterprise risk management systems, you will have some level of certainty that you will meet your business targets. Now, you notice that I mentioned business a lot at the outset while I'm still a compliance professional. And I think it's very important that there be collaboration between the business and compliance to achieve organizational goals and targets. We need each other. And very often when we think of AML or compliance and risk management, there is a misconception of us, the compliance people, against them, the business people. And that really should not be the case. Not having a proper system for enterprise risk management could mean your business is perceived as less sound and could even result in loss of clients and damage to your brand and your reputation. The practice of enterprise risk management involves making preparations for dealing with risks and deciding how to prioritize them and to respond should they arise. Typically, such systems focus more on control and internal processes. And I mentioned the need for continuous improvement through internal audit, through the implementation of compliance standards. All of these avenues are ways that you seek to control as much risk as possible. And we'll do a little deep dive on the types of risks that you ought to be focused on as I move along. Nonetheless, the key point for this slide is that enterprise risk management is the process by which, through understanding your business, you identify the risks that exist based on your target markets, based on your client profiles, and you put controls throughout the organization to reduce those risks and thereby enable yourself to achieve your business objectives. Balancing risk. Risk assessment is a balancing act. Yes, and it's not easy. It involves having regard to all the things that must go right and considering all those things that may go wrong and putting a plan in place to minimize the exposure of your financial institution. Now, I'm sure you've heard it before. The business owns the risk. So if you're in a compliance role, if you're in a risk management role, AML, the first thing you need to understand is the business decides what their risk appetite, risk tolerance, and risk threshold is. And the balancing act involves having regard to, like I said, the things that must go right and what can go wrong. The role of the AML compliance professional is to always be the watchful eye, reminding the business of the rules of the road, reminding the business of the laws, regulation, internal policies, and controls to ensure that the strategic objectives of the business are met within the full legal and regulatory parameters. Now, enterprise-wide risk assessment. In order to determine what your risk appetite is and your risk tolerance, you need to assess your entity and identify the risk that you are exposed to. Now, how do you do this? The first thing I would say to you is that a risk-based approach needs to be taken. And we all know that the FATF recommendations put forward that a risk-based approach needs to be taken not only at a country level, but at an institutional level. This means that you prioritize and you put your resources where the greatest risk lies. But the first step of risk identification The professionals conducting the risk assessment need to understand the entity's operations and working environment. They need to know where possible problems may arise. Financial institutions must take into account the characteristics of their customers, the products, services, or operations that they offer. They need to factor in the countries or geographical areas where they operate, as well as the distribution channels used. So, what is it that you're in the business of providing? Checking accounts, savings accounts, loans, mortgages? And what is your target market? Where do your customers come from? Are they commercial customers? Are they business customers? Are they individuals? Who are you targeting? And are they within your country? Or do you also service international clients whom you might not have face-to-face contact with on a consistent basis? All of this influences the risk. Are they from a particular sector? You have to factor in any international sectoral standards and reviews. So that means you need to consider whether there are any FATF ratings that you ought to be aware of with respect to a particular country that you are servicing clients from. You also need to consider whether there was a mutual evaluation of the jurisdiction. How have they been rated? What are the areas that they are weak in? That is, if you are servicing international clients. What is your own rating? The risk scoring must be calculated using a defined methodology. Frequently, risks are weighted. So customer risk may be weighted a little lower than country risk in order to bring balance and impact precision in the aggregate view of the risk category. The inherent risk scoring takes place before the consideration of internal controls and evaluates the nature, complexity, and volume of activities giving rise to the risk identified. So basically, you need to measure your risk without factoring in the controls that you have to put in place. The first step is to measure your risk, to score your risk, and then after is when you factor in your controls. You need to document policies and procedures for risk assessment. In general, AML risk enterprise risk assessment should be documented, updated, and kept at the ready in the event that your regulator asks for it. It should be updated every time that an event occurs that can have a significant impact on the money laundering risk profile of your company. Did a target market change? Was a new product or service offered? Are you in the middle of a merger and acquisition where you're taking on a new book of business that can impact the risk profile of your organization? Risk assessment is not a process that takes place once a year, but it's an ongoing process. You should have it at any time when there are factors influencing your business, where there are risks associated with the business that are evolving. The risk rating tool that you use should be available to internal and external auditors, your regulators, and your board of directors. Gap analysis. Gap analysis and prioritization is the analysis and assessment of the adequacy of the existing risk management measures. You will recall that I said you need to understand the risk and then factor in the controls. Once you've factored into the controls, you might see where a risk is not sufficiently managed. This is the gap analysis here. And once you identify that there is a lack of control or insufficient control in a particular area, the residual risk will be exposed. And it is the amount of risk remaining, that is the residual risk, after the implementation of controls that you need to focus on. That is where you then go to refine your policies. That is where you then go to refine your procedures. And it may be that the risk tolerance level is such that some residual risk is there and the business understands, owns, and accepts that. But having determined what the residual risk is, the adjustment phase allows you to introduce new or additional risk management measures. Underpinning all of this has to be a risk-based approach. You know the risk, you categorize them as high, medium, or low, and you put the controls in place that is commensurate or aligns with the level of risk. Obviously, high-risk areas require more controls, more resources, detailed policies, and additional due diligence. That is why I emphasize the risk-based approach. In order to conduct an enterprise-wide risk assessment, you will have to consider the specific risk factors and the principle of proportionality. Highlighted on this slide here, we have products and services, customers, and geographies. This is what you will need to focus on. Certainly, we know the watchword of AML compliance is know your customer. So compliance and AML on this dimension means establishing due diligence protocols that will help your financial entity to evaluate the risk with respect to its customer base. High-risk customers, that is politically exposed persons, it may be clients, international clients who you don't have a face-to-face relationship with, will need enhanced due diligence. So customer risk, you need to factor that in and have policies and procedures in place to align with it. Country, geographic, and location risk. The increasing emphasis on countering terrorism and the access of terrorists to financing has made location or geography an obvious source of risk. OFAC and other agencies maintain watch lists of countries. You will need to factor in and be aware and monitor these lists against your client base. Products and services. You need to assess the risk associated with the products and services that your firm offers. Small retail transactions over a long period of time with an established customer obviously carry a very low risk of money laundering. In assessing risk, the type of product or service might be generically more of a threat. Transactions involving third parties or outsourcing involve higher risk, since there are more ways for money launderers to structure the transfer of money. The explosive growth of digital networks and digital payment systems has also created new risks, and you need to factor that in as you assess your products and services. So where do compliance and risk management intersect? I've talked about both of them. Let me put it this way. Risk management is about devising the best plan. Achieving business objectives within the regulatory framework has been a shared objective of all members of the organization, including compliance. It has to be. Compliance and the business must have the shared objective of the business hitting its targets. The plan should be one that does not expose the institution to loss, be it financial, reputational, or otherwise. And so risk management is about identifying the risk, ensuring controls are in place, and then developing the business plan within those parameters. I like to say that compliance is results oriented. It's about ensuring that the institution stays on plan and achieves its business objectives in accordance with the rules set out in your various laws, regulations, as well as your policies. Compliance and risk management intersect, and they are not mutually exclusive. Risk management draws the map, identifies risk indicators, and assesses the level of risk. Risk management, in the broad sense, outlines what the safest and most efficient route is to achieve your desired business objectives. Compliance, on the other hand, ensures that the business, that is the driver, stays on the right course, doesn't get off on the wrong turn, doesn't break the speed limit, doesn't take a detour that could lead to regulatory sanctions, reputational damage, or get lost on the way to its destination of achieving business objectives, which tend to be heavily financial and bottom line focused in this very profit-driven world. AML governance. Maintaining an effective AML compliance program today requires so much more. It demands robust engagement with and by senior management and the board of directors. It is multidisciplined. It involves compliance. It involves technology. All of the stakeholders within the organization must be involved in dynamic risk mitigation strategies. Strong leadership and oversight are a critical part of protecting a business from criminal exploitation. And so we may have some business leaders in this webinar today, some directors and senior management. I think this is important for you to focus on the need for a collaborative effort, and we will talk about tone at the top. But for members of the board for a long time, it used to be, well, they provide some oversight, but there's a hands-off approach. And over the years, this has changed with the implementation of corporate governance requirements. Ultimately, the board is responsible for what goes on in the organization. And that responsibility is focused on AML CFT. For the board and senior management to effectively lead a positive culture of AML CFT, they must be fully engaged in the risk management process. This involves much more than just having AML on your agenda at board meetings. That's not enough, where you just get a report and you sign off on it and you say, okay, I've received a report. The board and senior management must engage, take questions, challenge, and they must take ownership of any money laundering or terrorist financing risk that the business faces. I said that the business owns the risk, and that starts with the board. The board needs to approve the AML CFT program and take positive steps to ensure that the requirements are met within their organization. So the board needs to approve and appoint the compliance officer, the AML officer. And I need to emphasize as well that the compliance officer or the AML officer should be at management level. This shows the level of priority given to this important area. Access to the board and senior management is essential for the AML compliance officer to carry out their job effectively. The compliance officer should oversee all AML compliance issues within a business to ensure that the business remains compliant with its obligations. And, it's important, therefore, for compliance, I believe, understanding once you're in a management level, you need to work with the business. I'm not saying that you need to bend to the business, but it's important for compliance professionals, because of the need for proper governance, to take a collaborative approach when interacting with the board, when talking about the impact of regulations on the strategy of the company. Risk assessment and management. For effective governance and oversight to take place, complete and accurate information must be provided to senior management, committees, and boards. And the information flows must be coordinated, structured, and cannot be solely driven by events or incidents. All I'm saying here is that the board needs to be regularly informed of what is going on as it relates to anti-money laundering, counter-financing of terrorism programs within the organization. The board needs to approve the policies and the procedure. And lastly, with respect to the compliance function must make sure that the requisite risk assessments are regularly reviewed and updated, transaction monitoring is taking place, that there is an independent review of the AML CFT program at regular intervals. Now, I mentioned this independent review of your AML program. While compliance may audit to make sure that the business is adhering to policy, it needs to be an independent review of your AML program to make sure that it is robust, to make sure that you are adequately managing the risk. In some organizations, this is done by an internal control and review function, which is separate and apart from the business and separate and apart from compliance. And I would want to note here that because the compliance function is so important, that role should also be the primary regulatory point of contact. Tone at the top. It goes without saying that tone at the top is critical to the success of any AML governance effort, but only if the words of the board of directors and senior management are supported by their actions. So your words must line up with your actions. The board and senior management cannot and should not play lip service to AML compliance. Unless the organization is convinced of the commitment of the board and senior management, there is risk that the tone at the middle, the managers, the people who have to carry out the work every day, will send that there will be a conflicting message sent to them about the importance of compliance. And the last thing you want in your organization is a tick the box approach. Because when your regulators come in, if they see that there's no real thought being given to the assessment of risk, to understanding your client profiles, that will not bode well for your organization. So move away from tick the box, where you're just going through the motion, and ensure that the tone at the top indicates that there is a real commitment to AML governance and AML compliance. Among the most impactful actions the board and senior management can take to promote an effective AML program are: 1, defining the organization's AML risk appetite. So make it clear what business you simply will not consider, what business you are not interested in. There are some organizations in my country, in the Bahamas, that have said, we don't take gaming business. We don't take on companies that are involved in gaming. That's outside of their risk appetite. But you need to be clear, and it may be different for you, but you need to be clear as to what your risk appetite is. You need to monitor changes in your organization's risk profile, because what might have been unacceptable a year ago may be a business type that you're now interested in accepting. But the process for that needs to be documented, and it needs to be explained within your organization. Examples of good tone at the top include following your company's own code of ethics. So you should have a code of ethics and a code of conduct, and you want to adhere to it. You want to hold people accountable who breach it, and there should be zero tolerance to crime and fraud within your entity. And certainly, there should be no covering up of wrongdoing. And there are some ways that you can improve tone at the top within your organization. Communication, promoting and displaying ethics and values within your organization, encouraging persons in the company to report misconduct, and rewarding people who do things the right way. Reward and recognition for those who do it the right way. And if you are trying to develop a culture of compliance that begins at the very top. Communication is critical. Communication builds trust. So there needs to be proper communication protocols within your organization, with your staff. But most importantly, you need to have good dialogue with your regulators. You need to build trust. And I would say to you that the best time to build trust with your regulators is when you don't have any issues, when everything is going well in your organization. And some people shy away from regulators. We don't want to see them unless they're coming to do an on-site examination. But I will tell you that you should meet with them regularly. Let them know what is going on in your business. Let them know what you are seeing. What are the trends you're seeing in the business? Here in the Bahamas, we have an association of international banks and trust companies. And every month we meet with the governor of the central bank. Every month they have a breakfast meeting with the governor. Sometimes there's more to say than others. You might just get an update from the governor on what's going on in the economy. Other times you will talk about the impact of regulation on your business. You will talk about trends that you're seeing in the business that may be causing you some concern. Like I said, there are those in the financial services industry who argue that it's much safer to keep your distance from the regulators. But I put it to you that this is not the right approach. Talk to the regulator when things are going well. If the regulator knows who you are and have seen you trying to devote resources to compliance and AML and know that you're acting in good faith, they will have more understanding if something goes wrong, absent, of course, to fraud or willful misconduct. So ongoing dialogue is critical. Talk about your business model, your target market. Where are you looking to grow? Where are your clients coming from? What are your strategic priorities? Those are the types of things that you ought to be sharing. Constructive engagement with the regulators. I like to say, think about your relationships with the regulator in these categories. In the business as usual category, this is where you're sharing those updates that I just mentioned. Perhaps you're investing a lot of money in technology. Maybe you just hired a new bright light in a compliance role that I want to say you stole, but you poached from another organization. So you're building talent in your company. Maybe you had an excellent external audit. You can share those types of things with your regulator so that they know that you're committed to a governance system that is consistent with the guidelines that they have put in place. And then you might think about your relationship with them and the need for dialogue when new regulations are being proposed. Very often when new regulations are put forward, it can have cost implications. It may mean that you need more resources in your organization. Let the regulator know. Share with them your views on the impact of any proposed new regulation. And if you're already engaged with the regulator and communicating regularly, you will have a distinct advantage in talking about rulemaking. If you're not already engaged with your regulator at this point, you should definitely open the lines of communication. What about an on-site examination? Now, I've been the victim of an on-site examination, or I've worked in organizations where I was sitting on the side of the table as a compliance professional and the examiners came in. And those periods can be very tense for you. But I think preparation is key. And if you give your compliance professional the resources that they need, your on-site examinations should go smoothly. But you need to know that an examination involves a sustained interaction with your regulator. In that examination, you have the opportunity to present your firm in the best light and to address any questions the examiners may have. So I would say that you, the business and the compliance, need to review any previous examination findings. Make sure that you have implemented the action plan that you promised to implement. They will ask to see your external and internal audit reports. Have those available and make sure that you're clear as to all of the steps you have taken to remediate any findings that came out of those internal or external audit reports. You want them to know that you conduct training. So you will have your training records in place for them to review. All of this you will need to show the examiners that your compliance function has adequate resources and adequate tools. And if there is support for the compliance functions from other areas in the company, you want to share that with your regulator, all of those things, because the degree of support the compliance function or the AML function receives from other departments within your business can be an indicator of how likely it is that your company is identifying and managing the risk associated with the business. The examiners will want to see that you are testing and re-evaluating your control programs. They want to see records and files, and they will interview your staff. So you want to make sure that your staff undergo the training. You want to make sure that everybody is reading from the same book, because when they ask the staff questions, you want to make sure that it aligns with what you have done within your organization. I would say be honest. And if there are gaps that you have identified and you are taking steps to remediate, let them know upfront. Remember, communication builds trust, and the most important time to build a relationship with your regulator is when you don't have any problems, when everything is going well. So I hope that you have found this presentation useful. And while I may not be here live, I want you to send your questions, and I will definitely review them and provide responses for them. Thank you very, very much.
Thank you, Tanya, for that presentation. Our next speaker is Pramod Khandelwal, who will bring in some interesting case studies to reinforce the ideas that Tanya introduced in her session. Let me tell you a little bit more about Pramod. He has over 40 years of corporate experience in banking and financial services, of which 20 years was with India's largest bank, the State Bank of India. Pramod was Chief Compliance Officer and Principal Officer at Intersect Bank India. He's an expert in banking compliance requirements and KYC AML regulations. He has authored several books, and he's associated with advisory services to banks and fintech companies. Pramod has a BTech honors from the IIT Kharagpur and a diploma in business finance from CA-IIB. Pramod, welcome to the webinar. Can you please...
Thank you, Arpita. Thank you so much for your kind words. Am I audible?
Yes, yes.
Am I audible, Arpita?
Yes, you are, Pramod.
Yeah,
we can
thank
hear
you. Thank you so much. So, good morning, everybody, or good afternoon, or good evening, depending on which part of the globe you are joining in from. At the outset, let me thank Fintelekt and Asian Bankers Association and Shirish and Arpita for providing me with this opportunity of sharing with the AML fraternity across the globe my thoughts on AML governance. Just give me a moment. So friends, we have really seen the elements of AML governance, even the risk-based approach, and how organizations, what elements are put in place and actions taken. As Arpita just mentioned, my idea is to really look into how we are really putting into practice this AML governance, what effect and impact it has had till now, since it was thought of, and what is that which could make the difference in the effectiveness and the quality. So the how part is what we would, and the best way to deal with this area is to look into some of the events and incidents which we have seen across the world. So let's first just take a look on the macro scenario of this journey of the AML CFT governance. We all know FATF, the key body which is driving the entire global measures. It has completed 3 decades now. Starting in 1989, they began with 40 recommendations very quickly put together in 90s, which they have upgraded, added 9 recommendations and brought about the AML standards, again 40 detailed guidance in 2012. Besides, they have been issuing guidance notes in several high-risk areas, and they have always tried to keep pace with the changes happening in the financial sector, businesses, activities, and even with the changes which have been brought about by IT. So much so, as you would be aware, even virtual assets and virtual currencies, while the governments across the world are grappling with whether to consider it as legal, declare it as illegal, FATF has issued detailed guidance even in those areas. And what you just heard, the mutual evaluations being done by FATF on various jurisdictions, and they upgraded the methodologies of evaluations and ongoing monitoring. Of course, we all know thrice a year they come out with the closely ongoing monitored jurisdiction. We have 2 high-risk countries still in the under the FATF banner, and 16 are closely monitored with weak AML. Now, the recent mutual evaluation talks about not just technical compliance, but effectiveness. So focus has increased on the effectiveness. And what has been the finding out of the 104 countries which have undergone this mutual evaluation? 27 are the member countries of FATF, of which 48% have been considered to be still low or moderately effective on the country level. Certain other indicators, AML Index, if you look at on a score of 10, the average is 5.22. The higher the score, the worse is the situation from AML point scenario. And 67 countries are scoring higher than 5.22. So that indicates AML is still continues, money laundering still continues to be an issue. Terrorism Index is another indicator, and you will find, though terrorism deaths, related deaths have been reducing over the last few years, 3 or 4 years, mainly because ISIS control over Syria has been dismantled, but there are still 32 countries where the terrorism score is more than 5. Afghanistan, of course, is at the top with 9.592 score. And the TI corruption perception, that is Transparency International's corruption perception index, which is one major component in the money laundering, total quantum of money laundering. Again, the average score is 43, and the lower the score, the worse is the situation from corruption point of view. Denmark is the least corrupt, the top ranking from the corruption point of view, least corrupt country. It still does not have a 100 score, it has 87. So, and 2/3 of the countries in the world are ranking below 50. And this is despite the compliance efforts being made in terms of quantum of money spent. $304 billion has been compliance cost estimate, which becomes 0.38% of GDP. And another estimate about how much do the corporates or companies invest on financial crime prevention puts it at 1.28 trillion. And despite all these efforts being made, AML penalties are continuing to increase. In 2019, major AML penalties were 58 in number, aggregating 8.14 billion. This was exceeded earlier only in 2014 when on one single entity, $9 billion penalty was there, and that's why the aggregate penalty in that year was exceeding 10 billion. And 2020 in 10 months, despite the COVID taking away a major part of this year, 13.74 billion penalties are already there. Another aspect which could be of interest, under mutual evaluation, it was noticed that effective understanding was found to be in 50% of the cases from low to moderate, the effective understanding of the ML and TF risks, and that is 3 decades have passed. Let us look at why the scenario, how it is like this, and how things can go wrong. Let me take first the example of Wells Fargo Bank. I would believe quite a few of you who have certainly come across what had happened in case of Wells Fargo Bank. Some of you, of course, maybe would be listening, knowing about it for the first time. For your information, Wells Fargo is a major US bank. It's in fact among the 4 big US banks, and it's a universal bank. That means it caters to almost all banking business lines. An institution over 170-year-old, which had acquired 2 banks in the earlier part of this century or later years of last century. And in 2016, it became one of the 4 US banks. What happened in Wells Fargo Bank, which was realized from 2017 onwards, or 16 onwards, from 2002 to 16, it was found huge number of fake accounts had been opened, both banking accounts as well as credit card accounts. This bank, for quite a few years, had been very aggressively marketing. Its focus on marketing was really very strong. In fact, one of its motto, which was very much publicized, was 8 is great, signifying that they wanted that Wells Fargo, every customer should have 8 products of Wells Fargo. That is the sort of goal, and they aggressively opposed, but the results, egregious and illegal acts in car loans, cars were wrongly repossessed, insurance of cars done when it was not required, even without customers' knowledge, even on the home loan mortgages, unauthorized home loans created, late fees charged wrongly, and so on and so forth. So much so, in the wealth and investment business lines, dangerous assets were sold to high net worth individuals, etc. And how did this come up? The media started talking about it sometime in 2011 or so. At that time, the committee of board, one of the committee, took notice of it, and then as a result of that, Wells Fargo started removing certain frontline staff. In fact, for 5 years, around 1,000 frontline staff were removed for misdemeanors, as they found. So totally 5,000 and odd people were removed. But the things continued to work in the same way. The media became even more open, more and more stories because of the customer complaints, and whistleblowers were coming up, and then board took cognizance of the situation being very serious, and external agencies were appointed to look into what was happening. But meanwhile, the regulators came in, and when regulators came in, $3 billion penalty, fake accounts, car loans, mortgages, etc., class action suits, settlement payments, payback So these were the financial implications. Non-financial, the bank had to issue apologies for repossession of cars. Its rating was downgraded. It was barred from increasing the assets. Things did not stop there. Out of the 11 board members, 7 board members were asked to step down and they were changed. Did the management and staff escape? No. Staff, the frontline staff, I already told, they were sacked. 4 senior employees were sacked. But the CEO, who happened to be chairman and CEO both, John Stump, he had to face the Senate committee in the US and he was accused of running a criminal enterprise, asked to resign, forfeited his pay, bonus, ESOPs, and drawback of $69 million. And the next in line, this one down who was handling all these business lines, heading the business lines, he also forfeited pay. He resigned of his own, but that resignation was changed to dismissal. And of course, $67 million drawback also. What was the public thinking and employees thinking? Here, one customer says, in February 2018, he received a foreclosure notice for a property which he had free and clear for quite many years. So he looked up his credit report and he found 16 fraudulent loans equaling $2.7 million in his name, which he wasn't aware of till that time. An employee says vision and values in the bank were just words and not lived out by management. And therefore, having the elements in place itself is not enough unless it is acted upon. It has to be supported by action from the top management, tone at the top, as it was just said a short while ago. Another employee says, no buffer between rogue managers and conscientious employees at the middle level. So the tone at the top, the tone at the middle, both were not what they ought to be. And that leads to a situation which we have just seen what happens. And how long does the impact lies? Wells Fargo, since John Stump has seen 2 CEOs change. Charlie Scarf, the current CEO, he also had to face House Financial Services Committee, and in that, the chairman of the committee tells him, I wish you luck. This committee is very clear that the organization you have inherited is a lawless organization, caused harm to millions of consumers. Just think of the reputation of one of the big 4 banks, which was very highly reputed, how soon it has eroded because of this situation. So what essentially are the key elements which works when we talk of AML governance or governance? Governance, compliance, ethics, and culture. These are all interwoven. Governance is not just having the systems, procedures, policies in place, not having just control measures, but governance is actually the manner in which the business and affairs are governed by the board and the senior management, who then decide in what manner they decide the corporate objectives, the business operations, how it will operate, and how the accountability and expectations will be met. Accountability to the external stakeholders and meeting their expectation and protecting the depositor interest. And this essentially requires not just by action of complying with laws, but ethics. That means going beyond what the law requires, doing the right thing in the spirit of the law, in the spirit of basic ethical values. So ethics is high-level values and standards of behavior, choosing the right thing to do. And when the governance and ethics together, they decide the compliance framework and they build up the culture in the organization. The culture essentially is the behavior of the people in the organization right from top to the bottom. So the culture is set by the tone from the top, the purpose and the strategy as it is defined, and how the governance and controls are then exercised, and the mindset and behavior of each individual at various levels is assigned to, and it operates on high level of values and standards. And naturally, every individual is accountable and every individual owes up the accountability. So that's where the basic how and quality and ethics is important. Let me take another example from my home country, of course. I am from India, from Mumbai, the financial capital. And this is a case of Bank of Baroda, one of the large public sector bank in India, and which is experienced a peculiar situation in the New Delhi branch, one of its branches in New Delhi, the capital of this country. This branch was given the authority to conduct forex business in 2013, and within a matter of 1.5 or 2 years, its forex business jumped from about $500 million to $215 trillion. As a component of this, it was found there was a set of transactions over some 14-15 month period, 35 trillion Indian rupee, I'm sorry, that was Indian rupee, and 35 trillion Indian rupee were sent out of the country, mainly to Hong Kong and some amount to Dubai, over 5,600, 800 transactions, all valued, each individual transaction valued below $100,000 because that happened to be the statutory threshold for certain compliance requirements. For what purpose? For importing fruits, cashews, rice, pulses, which never took place, of course. These went through 38 accounts to 400 entities. What was the source of the funds? From 30 bank branches in the country, all across the country, some 48 trillion Indian rupee flew in, and there were cash deposits of nominal amount of relatively 3.43 trillion Indian rupees into 59 accounts. The remitters, all remitters were shell companies who remitted the 35 trillion, and the beneficiaries in Hong Kong and Dubai were all shell companies. It would be interesting to just mention this Star Exim Limited. Its address in Hong Kong did not have any employee of Star Exim Limited sitting out there. There was an office, of course, but the office was manned by a person from another organization, again happened to be an associate, and who was the owner of this Star Exim Limited, a small-time coal dealer from one small town located some 800 kilometers away from New Delhi. So these were the type of the entities who were doing the business through that branch and remitting abroad. So there were omissions. Yes, there were several omissions at the branch level, customer due diligence, transaction due diligence, new account monitoring. At the head office, new business monitoring, sharp jump in the businesses, these signals got unnoticed. No ongoing controls seemed to be in place. The AML team itself had deficiencies in the CTR system, that is cash transaction report, cross-border transaction report system, so defaulted in filing those in respect to these accounts, and also suspicious transaction reports detection happened late and filed late after the internal audit had pointed out this fact that this is what has happened. So there were basic deficiencies in the AML system. While these were just compliance or system lapses, but there were some misdemeanors at both the branch, the BOP branch. There were a couple of dealing executives whose actions were suspect. Another executive at SDFC Bank Forex branch was suspect, and they were then subsequently put under arrest. And individuals who were involved behind this, some of them who could be traced out, it was found that was their business, setting up the shell companies, opening up the accounts in the name of those shell entities, and transferring. One Sanjay Agarwal transferred $4.3 trillion, another Chandan Bhatia transferred $4.2 trillion. So they might have had another 6 or 7 individuals, each transferring about $4 trillion, adding up. So several perpetrators were also arrested. There were 5 persons. So bank, and what happened to Bank of Baroda? It faced penalty. 50 million INR from RBI and 90 million INR from FIU, one of the heaviest penalties till that point of time by the Indian regulators on single entity. So what happens here is we find the governance can be impacted, the quality of governance and the effect of the governance can be impacted and influenced by several factors. I'll quickly just point out the enterprise level governance, apart from what we found that yes, the tone in the enterprise at the top and middle, the culture should be good, but it also gets impacted by the national level governance. If the national laws, regulations, regulators are of higher standard, the enterprise level governance naturally will follow that line and it is likely to be better off. Another influence is on the counterparty country and counterparty FI one deals. Money laundering and terrorist financing of financial crime transactions today are all conducted in a chain, not confined to just national boundaries or just local cities, but cross-border. And therefore, the impact of the level of governance in the counterparty country, the level of governance in the counterparty financial institution from whom funds are sent or from whom funds are received, also impact the effectiveness of the governance of my bank or my institution. And how about the global scenario? If globally, we have seen right in the beginning that still globally, a lot of work needs to be done to make effective impact on money laundering, terrorism, and the financial crimes. So the global weaknesses impact the effectiveness of the enterprise governance. The enterprise at the local level is also impacted by certain factors which often do not get talked about. Despite having good governance, after all, any bank, any financial institution is a part of the ecosystem of a country first. And it is there to do business. It is there to facilitate, to meet the needs and demands of the financial services of both individuals and businesses in the country. So naturally, its business or quality of its business depends very much on the trade and commerce practices and social and criminal environment. If corruption and tax evasion is rampant in any jurisdiction, it's difficult for a bank and financial institution in that jurisdiction to escape, not to have its own business tainted with corruption funds or tax-related funds. Similarly, if on the social aspect, say, if child labor is rampant or drug use is rampant in the country, the funds related with either child slavery or drug peddling are likely to flow in. And similarly on the criminal aspects, the escaping for the enterprise will be difficult. And the responsibility for this ecosystem lies on statutory authorities and judicial systems. The financial institution is a financial soldier, rather it's a financial informer, a gatekeeper, which can sensitize, which can send alerts to the statutory authority, the FIU, but the actions by the statutory authority and judicial systems is going to really affect the whole ecosystem, including the financial sector. So that impacts the AML governance of the essence or the effectiveness of the AML governance of the individual enterprise. Apart from that, yes, enterprise itself has to be conscious of certain aspects. It's important to see malafide and unethical practices do not happen. Unethical approach, if the tone at the top or tone at the middle is unethical, that can have serious impact. But if the top and the middle are conscious, any unethical practice at the lower level can be quickly detected and curbed, particularly when the messages are proper and appropriate. The skilling of resources is important in this area because the skills to detect anything which is connected with money laundering, terrorist financing, skills to detect unethical practices, they need to be there at all levels, and so that timely actions can be taken. And when dealing in today's dynamic situation, our ecosystem, working environment is changing. So having the capabilities to deal with new approaches, new innovations happening, that becomes important, and upgrading the systems accordingly. So that can make the AML governance more effective. Lastly, I will just share a few thoughts which I have on meeting certain challenges which we face day in and day out. The financial sector needs a lot of support from LEAs and FIU, particularly in respect of sharing of typologies, of whatever new typologies they come across in the money laundering, terrorist financing, or financial crime area. If it is widely disseminated, a lot of learnings can be there. Public and private coordination is very important if there has to be effective impact on curbing ML and TF. Already certain countries, these initiatives have started. In Australia, Fintel Alliance is there, where not only Australian entities, some of the UK entities, New Zealand entities, and the private sector and public authorities in Australia together work together. Trade bodies support can be taken. Today we find all industries, trades, even on micro enterprise or small enterprises have their trade associations. Bulk of the trade are genuine, so they would really be interested. So we need to make them responsible, sensitize them that they need to take care that their businesses are not really contaminated by criminals by abusing their businesses. So that can help us in our due diligence, that can help us in getting support from our own customers in trying to have the right persons on board. Focusing on our goal is we cannot really take place of investigators or law enforcement authorities. We cannot find concrete evidences of wrongdoings, but common sense, very reasonable, very strong suspicion about something being wrong. That is our role, and really alerting in time the FIUs with that, whatever information we have got, sharing, that becomes important. Financial sector can share a lot of learning among itself. In some of the countries, therefore, there are forums of compliance officers, money laundering reporting officers, and that helps in learning. And this can be taken up in various countries. Within the organization, the updation of organization systems on an ongoing basis is really key point. At several places, only because certain systems lagged behind, the organization had to suffer. Last but not the least, I would like to really talk about Compliance in business, it's always talked about the working conflict. Compliance is for business, supporting business. In fact, compliance is not at par with business in most of the jurisdictions. From the point of view of organizational influence and empowerment, that needs to be brought at par A. B, business has the primary onus of compliance. This message needs to be really clear. Otherwise, the compliance can always just remain on paper. But when business owns the compliance, so all business strategies, etc., will have compliance at the helm of the affairs, and that will make the organizations much better compliant. Thank you, friends, for your attention, and I'm open to any questions if you may have.
So thank you so much again for joining us today and all through 2020. Our webinar calendar for 2021 will be up on our website in the first week of January, and I hope to see you all again soon. Meanwhile, from me and the team at Fintelekt and the Asian Bankers Association, here's wishing everyone a happy festive season and a happy new year in advance. Stay safe and stay healthy. Thank you.